Welcome to the De-Risk Global Markets Daily Brief. It's Monday, November 10th, 2025. The big story today is a profound disconnect. On one hand, we have severe economic warnings coming from the U.S., where the longest government shutdown in history is taking a heavy toll. Consumer sentiment has plummeted to a near-record low, and the Treasury Secretary is warning that fourth quarter growth could be cut in half. On the other hand, markets are rallying with surprising force. U.S. futures are pointing sharply higher this morning, with NASDAQ 100 futures up nearly 1.5% to 25,540, and S&P 500 futures adding almost 1% to trade at 6,818. This optimism isn't just a U.S. phenomenon. It follows a bullish handover from both Asia and Europe. It seems investors are looking straight through the grim economic headlines and focusing on something else entirely, the prospect of a Federal Reserve rescue. The worse the data gets, the higher the odds of a policy pivot. Alex, this feels like a classic case of bad news is good news for asset prices. Can you break down how this dynamic is shaping the action across the globe, starting with the risk-on mood we saw in Asia?
Absolutely, Sarah. The bad news is good news narrative is precisely what's driving the cross-asset currents today. Starting in Asia, the mood was decidedly bullish. Japan's Nikkei 225 rallied, closing up at 50,911.76 from an open of 50,645.27. This move keeps it firmly in its uptrend, trading substantially above both its 50-day moving average of 46,673 and its 200-day of 40,452. While the Bank of Japan is signaling a desire to hike rates, persistent weakness in wage growth is keeping them cautious, which in turn is keeping the yen suppressed and supporting equities. Hong Kong's Hang Seng Index followed suit, rallying to close at 26,649.06, also well clear of its 50-day moving average at 26,141. That positive sentiment carried over into Europe. The FTSE 100 in London rallied, closing at 9,780.30, a solid gain from its 9,682.57 open and comfortably above its 50-day average of 9,428. In Germany, the DAX was more subdued but still positive, closing at 23,991.44. That's just a hair above its 50-day average of 23,958, reflecting the underlying drag from Germany's stagnating economy. But for now, the global liquidity story is overpowering local concerns. And that brings us to the U.S., which is the epicenter of this whole narrative. The catalyst is the government shutdown, which has created what the Fed calls a data fog and crushed consumer confidence. The University of Michigan Sentiment Index just hit 50.3, the second lowest reading ever recorded. Here's how markets are interpreting that dire news. First, rate expectations have shifted dramatically. The market is now pricing in a 65% probability of a Fed rate cut in December. This is the engine driving everything else. Second, look at the U.S. dollar. The DXY is soft, trading around 99.57, which is below its 200-day moving average of 100.43, reflecting those rate cut bets. Third, and most spectacularly, is gold. The yellow metal has surged, closing at $4,089 an ounce. That's a 56% gain year to date. It's a direct beneficiary of a weaker dollar and the flight to safety amid the shutdown uncertainty. Conversely, crude oil is telling the economic slowdown story. WTI is struggling around $60.21 a barrel, trading below both its 50-day average of $61.53 and its 200-day of $64.93, confirming a technical death cross. Weak consumer sentiment and forecasts of a global supply glut are a powerful headwind. Finally, volatility remains surprisingly contained. The VIX is actually down about 2% to 18.7. There's no panic because the market is confident the Fed will step in. So the global rally isn't built on fundamentals, Sarah. It's built on the expectation of a Fed rescue mission. Back to you.
A fascinating and fragile setup, Alex. The market is walking a tightrope, balancing on the hope of a policy backstop against the reality of economic damage. The low VIX reading in this environment is particularly telling. It's not complacency, but rather a very specific bet on central bank intervention. Looking ahead today, the focus will remain squarely on the Fed and any signals about its path forward. We have speeches from the Fed's Mary Daly at 8:30 a.m. Greenwich Mean Time and Adriana Kugler-Muslim at 9:45 a.m. Greenwich Mean Time. And traders will be parsing every word for clues on how they're navigating this data fog and whether they share the market's dovish outlook. Elsewhere, we'll get the Centix investor confidence reading for the Eurozone, which will give us a fresh take on sentiment there, especially in light of Germany's economic struggles. Later in the U.S. session, a series of Treasury auctions, including 3-month, 6-month, and 3-year notes, will serve as a key test of investor demand for U.S. debt amidst the political turmoil and shifting rate expectations. It's a delicate dance between economic reality and policy hope. The market has clearly chosen its partner for now, but we'll see how long the music lasts. We'll leave it there. Thanks for listening to the De-Risk Global Markets Daily Brief. Disclaimer. All information provided is for educational purposes only and does not constitute investment advice.